Let's bring in Tom Kennedy. He's head of research and investment strategy at JPMorgan Asset Management. Tom, do tell, because I've gotten many questions about this. What kind of new portfolio do you think this demands?
Yeah, I think we got to start with this end of globalization era. Kelly, it builds off a little bit of what Erica and Steve were talking about. Globalization allowed us to optimize where resources are across the world, to bring down inflation, to bring down interest rates, and raise the wealth profile. So fascinating about the tariffs is that the manner through which it was calculated, which Steve talked about, so surprising because it's not traditional trade management. However, it shows you that this imbalance is the thing that the Trump administration really wants to target. So if the things that shaped investing in globalization were lower inflation, lower interest rates, and the inverse correlation between stocks and bonds, if we deglobalize, we should expect that that will reverse itself and inflation will be structurally higher, and maybe bonds aren't the traditional diversifier we have built them to be over the last few decades.
Although right now they're acting certainly as you'd be happy if you had bonds in your portfolio right now.
Yeah, I think that's right today, Kelly. When you look back over the last 5 years, and I think this era of deglobalization, or at least the end of globalization, started with the pandemic, where we were shocked into this environment where full globalization, where I can take supply chain inputs from wherever I am in the world, that got shocked. And since then, the inverse correlation between stocks and bonds hasn't been there. I agree with you. If we get a really big growth scare, surely yields will come down. But can they insulate you the same way they did for the last 20 years? I don't think so.
Let me run through a few of the questions that we've gotten in the past 24 hours, Tom, on the markets, from when do we bounce back up to, boy, was I wrong that this would be a buying opportunity. What do I do now? Another person saying, is just straight up, is this a buying opportunity? For retirement accounts, is the S&P still the place to be, or is this a time for safe harbors? And then others asking, if nations keep responding with more tariffs and then we go on top of that and so forth, will it set up the conditions for a global market crash?
We're walking into a world, Kelly, where uncertainty is obviously high. That's stating the absolute obvious. I think when we start to look through the tariffs that happened, the manner was odd. And yes, they're not necessarily reciprocal. But where it's shaking out, it seems as though the Trump administration is focused on China and Southeast Asia. Hear me out. Mexico and Canada, not a part of the tariff announcement yesterday. That's an upside surprise. EU tariffs, more or less what the market expected. But China and Southeast Asia tariffs, which you've been talking about with respect to Vietnam, 50% or higher. I think we can conclude that the administration is increasingly concerned about the supply chain dominance that China and related countries have developed over the last several years. At the moment, you can't use this phone without refined rare earths, that 90% of them come from China. So we have this dominance there. I think the things we can feel good about is that the manufacturing offshoring that has happened is going to come back. So I can't sit here and tell you I think we're at the bottom. I really don't know. But I think the things that we should feel confident, even as this shakes out, there will be a reindustrialization of America, and that has real estate implications. It also has sector-level implications for the S&P 500.
Can you walk through those quickly, Tom, before we let you go? Because that's where the rubber meets the road, and investors want to know where to put their money.
Yeah. For the last 20 years, you've seen no manufacturing capacity in America built really on net at all. Warehousing capacity, you have almost 5 billion square feet of warehousing. So we have embraced globalization. There's going to be needing to be some direct investment in manufacturing capacity. It's already happening in places like Phoenix. But you're also going to need to reorient your portfolio to think about a new ballast. So I think real estate could be that, maybe infrastructure. But focusing on the 40% of your portfolio, the fixed income piece, I think we're going to have to find a new way to keep portfolios resilient.
Interesting. Tom, thanks for joining us. Really appreciate it today. Tom Kennedy.